All right. Good morning, everybody. So we got hedging activity this morning. It seems the markets are a little concerned about the data we're going to get. So we should be a little concerned about the market data that we're going to get. Also looking at the projected FOMC rate decision, it looks like the market has priced in a 25 basis point rate cut with a 95% chance or 95% certainty of a cut. Definitely want to watch this throughout the day today to see if the numbers that we get change this in any way. FOMC is normally on a Wednesday. November 7 is on a Thursday. So we won't have FOMC on the typical Wednesday, at least not at this point. It is possible that that could change, but usually if it's going to be changed, they'll have it in like a shaded gray. So it's just a little weird. It's worth noting. And then we have QRA next week. That's kind of be a big deal too. But for the moment, it's all a focus on the data we're going to get this morning. The markets are pretty much in line. Nothing, no outliers or anything like that. And I think by the afternoon, we're going to have a clear afternoon. Yeah, it should be fine. I mean, if you're trading in power hour, then you might want to watch out at 3:30. But other than that, once we're through with Collins, we should have a clear afternoon. So as I mentioned, we can see the market maker move today. If you don't have that indicator, or you're on a broker that doesn't have it, go and look at the options on the futures. So you can see it's still showing yesterday's with that -1. Just scroll past that. Put these closer together so I kind of see what's going on here. The front is higher than the next expiration out. That is an MMM, or market maker move. I know it sounds really fancy, but it's something that Thinkorswim made up, right? They just made it up. They said, "Oh, hey, this is really cool. It's an insight. It shows front end trading activity." They never used it for the futures either. They always focused on equities with it, especially around earnings and that sort of stuff. But if you use this platform enough, you understand options, you sort of get to where I got, which is, oh, hey, they're also using it in the futures. So it's no, advanced indicator of performing some crazy calculations. It's just looking at the implied volatility average on the options chain. If they're hedging in the front end, it'll jack the implied volatility of the out of the money options, which will make the average go up. And we can see the volume this morning on the put side, 4 different strikes where they've been hitting, over 1,000, and on the call side, 1 strike. So they're mainly hitting the put side. I guess there's 2. They have this in the money one. That 58.50 is what I put on the chart here. I built a straddle based on that 58.50 from the 1,000 options that were traded on each side, the call and the put. And if we do that, the break even is right there. That's the straddle edge. So I don't know. I'm going to keep my eye on it today, see if we get into that area. But the idea is you want to watch the clock. They're hedging because of an economic event on the table. The economic events for the day are easily found, whether you're using finance juice or FX Street. 8:30, 10. It's going to be one of those two. Very likely it's the 8:31, or they probably wouldn't have started hedging this early. If we're wrong, after 8:30, this number won't go down. It'll hold where it is, or it'll even go up a little bit more. And that would tell us, hey, it wasn't the 8:30 event after all. It must be that 10 o'clock event. Either way, after 10, if it's still not gone, then watch the news. Keep your eye on finance juice, because there could be something else on the table that we don't know about. That might sound odd, right? We check 3 different websites every day, and you can always go in and look at things like your IBKR, TradingView, Thinkorswim. They all have these economic calendars built into them. You can check those too. But even with all of those, you're not getting everything. There's a lot of events that go through every day that never hit the headlines. They don't show up in these calendars. They're just not there. And you may think, well, so what? If there's minor economic events, there's a million of them. We don't need every single one of them. Yeah, but even really big, really important events like QRA don't show up in there either. So you can't dismiss it and say, well, if it's not in there, it must not be important. QRA is really important, and it never shows up in there. What else is important that doesn't show up in there? Volume's kind of in line. It's what we've seen throughout the week, mid 50s, mid 60s. So typically when we get hedging, we see a lower volume, a lower participation. And we're not seeing that. We got the same amount of volume today in the overnight that we've had pretty much for the last 2 weeks. So that's a little odd. It's kind of an outlier. At least want to note that activity, but it's not unusual. And we're up about 1/4 of a point, which puts us right against the 10-day moving average. And we're holding above VWAP relatively well. So just kind of maintaining the IX10 that we built the other day. So IX10 is another one of those really fun, fancy, sophisticated sounding, complex things. This is Wednesday's price action. This is Thursday's price action. So that's called an inside day. Wednesday is inside of Thursday. But now here we are Friday, and so far we're still inside of Thursday's range. That's IX10. It's an inside day that has lasted for more than one day. Depending on where you find an IX10, it can be significant. The idea behind it is that if you're focused on a very small candle and a very small range, and then you get 2, 3, 4, 5 candles in a row inside of this very small range, when we leave that range, it'll be explosive. It's like a squeeze, right? Get a lot of market compression, a lot of volatility, and then the big expansion afterwards. The problem is we're not sitting inside of a really tight, narrow IX10. Wednesday's range is really big, and then we're inside of it. Well, that's not market compression at this point. We're also sitting inside of Thursday's range, which is a lot tighter, a lot smaller. And if we stay inside of Thursday's range all day today, and then Sunday night into Monday, we're also inside that range, then it would be a really tight IX10 narrow range, right? So we're in an IX10, but since it's so wide, it's basically, so what, right? But we're also just inside day from yesterday. So, I'd roll with that inside day of yesterday and not focus too heavy on IX10 at this point. For the difference between the ES and the NASDAQ, we're getting our inside day breakout on the NASDAQ, which we didn't get on the ES. So we're no longer even inside day if we can hold this breakout. And for IX10, it's a big, massive candle, which again puts us into, so what, right? That big, massive candle isn't helping if we're thinking about compression and the possibility of a massive squeeze. Both of them, whether it's the NASDAQ or the ES, are both above the 50% mark of that really big day. And both of them are above the 50% mark of yesterday. The ES just failed to get that breakout. Now, when you think about failing to get the breakout, it didn't even get to the edge yet, let alone manage to break out of that edge. The NASDAQ 100 doesn't have financials. The ES does. That's one defining difference or characteristic between the two. Banks like it cheap and steep with the 10 and 2 yield curve back up above the zero line and holding, I think the last look, it was like 0.15, still holding cheap and steep. Banks are doing well. Where's our breakout, right? Why aren't we getting that follow through? Assistance from the banks. I don't know. With the market maker move here and the hedging activity this morning, I'm surprised that we're getting anything. I would expect sideways, a very narrow IB, a lack of follow through, a lack of breakout while we wait for whatever it is they're hedging on. So far, it appears positive. If you look at everything we got from the Asian session and so far in the European session, we're holding above the VWAP on the day. We broke out of the Asian session high and got into the week's VWAP. So we're maintaining a bullish posture at 0.25%, but we're still just waiting on data. So no edge on whether or not we'll hit the ADR half. It is worth noting that the lower ADR is basically yesterday's low, but the upper ADR half is after we get an inside day breakout. So to even get to this upper ADR half, we've got to get a breakout first, but we don't have to on the other side. That doesn't go very far, right? It's just something to take note of. Same thing with that straddle that I mapped out a little while ago. That straddle, one edge of it was inside the range, the other edge wasn't. We're still maintaining underneath the weekly pivot point, and it's worth noting if we get a breakout today to the upside above yesterday's highest point, 58.92 cog line is my target with an overshoot back to the floor pivot by the end of the day. Since it's Friday, you think about something like SPY with some cheap lottos. It wouldn't hurt buying some 583 calls at the open if you can get them pretty cheap, right? And I mean cheap. This is a gas station lottery ticket, right? You don't spend $50 on a scratch lottery ticket. And the reason for that is because your success rate is really low, right? It's a lottery ticket. You have a 1 in a million chance of actually making any money. But when you hit that lottery ticket, as a winner, well, then, it's a nice payout. Really cheap. And so you don't mind when you lose a million times before you finally hit it. If the 583s are really pricey, then you don't want it, because then it's not a lottery ticket. It needs to be so cheap that you don't even care. Now that's relative. Some people say, I don't even want to lose $5. It's too expensive. While others are willing to throw $50 at it and not even blink, right? So cheap to you. It's your wallet. If you can't do it as a naked call cheap enough to suit your needs, turn it into a call spread, right? Like, who cares? Even a butterfly at 583, that should be crazy cheap. A couple of pennies. The commissions on the butterfly would probably be higher than the cost of the butterfly itself. That'd be pretty cheap. And butterflies, I mean, if you can risk 2 or 3 pennies and then, you net 75 out of it, it's good enough for me. I will risk $3 to make $70 to $75. So that's if we get the breakout. That would be my target for the day. Now we can overshoot that and keep going. It's just that would be the target. For the ES, 58.94. For the SPX, 58.50. Pretty simple, nice round number. On SPY, 583.5 is the 1-day estimated move to the upside. So that lines up really well too, right? At least we don't have to run through some GEX levels to get there. To the downside, if we break yesterday's low, we'll target Wednesday's low. And then below that, we'll start to focus on the 111 and the 1236. So 57.92 cog line and then 57.75. Some round numbers. I don't think it's going to get nasty enough that we would see something like 57.50 today. That just that doesn't really fit with what we see so far. On this discussion of a rally back up, it's really just a discussion of tagging that floor pivot for the week. It would not fit the narrative to set a high higher than that high. We're still expecting lower lows and lower highs because we're working on this downtrend. So if we break that and we get above this high, then we're not in a downtrend. We're developing a complex topping pattern, which is completely different. Looking at the volume profile for the week, 58.89 is where our point of control is. That's a front run on the 58.92 cog line, which is our target on that floor pivot. If we get near that, it'll start to act like a magnet. It'll draw us into it. We've expanded far enough away from it at this point that if we do get drawn towards it, it's very likely going to act as a resistance as well. And if you want an example of what that looks like, look at last week. We did the exact same thing. We were holding around that point of control, faded away from it, and once we got near it, we came right up into it, but we cut through it, right? We didn't stop right on the line, turn around and go back. We managed to get into it, cut through it, and get into the same zone that we had been before, right? So, think of it like a band around that point of control. We don't want to focus on one tiny little line, but instead we want to think of the entire zone. So same thing, if we can get through this high, call it 58.70, it's likely that we'll be drawn back to that like a magnet. And we could overshoot it. So I use something called a surge indicator. That sounds really awesome, but it's nothing more than two moving averages. The 3 and the 10, when price crosses through both of those moving averages, we then look for the moving averages to flip. We had that crossover earlier in the week on Wednesday when price cut through the 3 and the 10 and closed underneath it. But after that, we need the 3 and the 10 to cross, which we got on Thursday. Now we've expanded that a little more into Friday, but price is trying to get back above both, which makes sense when you have, say on a daily chart, price crossing through the moving averages to the downside, getting a little bit of a pullback, and now trying to rally back up again. We're on a daily chart here. There's the 3 and the 10. So on Wednesday, price cut through both of them, and then the 3 and the 10 crossed. This morning, we're looking to see if price is going to be able to get back through both of them in the other direction and continue the move to the upside. What it would look like is a lot like this, where we had a run, price crossed both, and then got back through both, and then the moving averages crossed back over again for the continued move, right? That crossover and run is surge. The problem is when we get tangled up, it can last for a while, right? Once the moving averages start going sideways and you got price just crisscrossing back and forth, well, it's junk. There's no value to it, right? They're not supportive. They're not resistance. They're not indications of momentum or surge or strength or anything. It's just trash at that point. It lasts for more than one day. So you don't have to try to get into it as soon as things cross over. If it's a good cross, it'll stick for at least a week because we're looking at it on a daily. Of course, that same concept can work on any other time frame as well. But if this is going to complete the surge signal, then we're looking at, getting through 59.25 and into 5,600 on the continued swing and run. Just remember, we got a lot of stuff coming between QRA and FOMC, not even looking at unemployment and everything else that's on the table. So sure, we're starting to set up for this. On the other hand, it is worth noting we already broke it to the downside. This could be nothing more than a test as a part of the move down, right? You come up a little, and then you come up a little, and come up a little. We're already counting lower highs and lower lows, looking for the next lower high. You get a full set, that's your downtrend. $10-day, 30-minute volume profile. The TPO and the volume profile are lined up with their point of control. 58.87, that's right in the middle of where we want to go today, 58.92 cog line. So if we get that breakout of yesterday's high, seeing this as a gravity point really makes sense, that 58.90 area. but getting through it, getting a continued move into 59 and 59.11, I find that really difficult to believe today. It's likely if we get near that cog line that we're going to end up getting stuck around it like gravity. So that VPOC line that we marked from Wednesday, we ran it over on Thursday. It has no value to us now. We don't need it. Take it off. We don't have a new one from Thursday because we've already cut through that level multiple times. So that's not going to be useful. We have started to expand a little bit when we got into the European session, but we're still holding the range, waiting on data. And because it's Friday, we have next week's range. It's just not set in stone yet. So this is a preview of what next week's range will look like. These ranges are measured based on volatility and time. Well, we have 5 days next week, just like we had 5 days this week. So that didn't change. The only other thing that would change would be volatility. If the range next week is bigger than the range from this week, then we can see that there's more volatility being priced into the range. And next week's range is not bigger at this point, it's smaller. At first glance, that may sound good because we think, okay, less volatility, maybe there's less economic uncertainty, less things to be worried about on the economic front. Unfortunately, that's not exactly true. Events like QRA and FOMC, they are volatility suppressing events. I know the first time I heard somebody say that, I thought, what are you, an idiot? You've never seen what happens on FOMC day? That's the very definition of volatility. The problem is getting to the event, the days leading up to the event. The markets often will go sideways waiting on a big event, CPI, non-farm payrolls, FOMC, and that sideways activity is a lack of movement. It's lower volatility. So if next week's range is smaller than this week's range, don't automatically assume, oh, we must have a smooth sailing next week. Nope. It's very likely the markets are starting to price in range and contraction while we wait for data like QRA, and we got some good earnings next week too. So this range isn't set yet. It's just a preview. It won't set into place until 4:15 today. Throughout the day today, it's going to continue to move. As price moves up and down, these lines will shift with price. So we'll see what we get by the end of the day. We'll look at it on Monday in the morning briefing. We're 2% above the 10-week. It's exactly where we want to be. We're kind of holding the line here. We're not overbought. We're not extended. We're just sitting in a really good spot. That's just a good, healthy position to be in. Looking at the 10-day, well, we were just talking about it, crossing back and forth through that level, and that's fine. It's a bit of a reset, right? We're back to the mean. We're back to the center of the basketball court. From here, we could move 1.5% in either direction, and we still wouldn't be overbought or oversold. So gold miners, nat gas, they're all down this morning. Solar, China ADRs, the Mag 7, semiconductors, cloud computing, they're all up this morning. They're not up by very much. Names in the NASDAQ that are up at least 0.5%. There's 11 of them. A couple of them are semiconductors, which some of these had an event this week, and some of them have an event over the weekend and into next week. I know ON is on that list. So is Broadcom, I think. Still, looking at the list, it's not the big one, right? We don't see NVIDIA on there, the leader of the pack. And on the S&P, also 11 names that are up at least 0.5%. Not the kind of names that we really want to see either. You don't want to rally on Nike and Lowe's, Salesforce, right? We want rallies on the Mag 7, consumer discretionary, some financials in there. That doesn't mean we should be negative. It just reinforces the idea that the markets are waiting on this data, and until we get it, they're sitting out, which makes sense. So Apple and Tesla are down a little bit of a mean reversion after the move yesterday. Not a surprise. It's just a market on hold, right? We're waiting on data. All right, on solar, it's just a big algo print way up here at 38.25. It looks fantastic, right? When you see it in the watch list, like, oh yeah, wow, it's up almost 3%. Yeah, but it's not trading there. We got an algo print, and that's it. We would want to see sustained trading activity, validating that level. Otherwise, what we see a lot of times, and we can just scroll back and see examples of that, is in the pre-market, we'll get some algo print higher, and then, you know, it doesn't stick, it doesn't materialize, or algo prints lower, for an example. So don't get too excited about that big print way up there. Not yet. All right, simple enough. Keep your eye on this throughout the day. I mean, you don't have to sit there and stare at it. Just revisit the FedWatch tool throughout the day today. I don't see that they're going to start unwinding this 2 weeks before the FOMC, but it's absolutely possible. Anything that pulls the market's perception of what they think the FOMC is going to do in 2 weeks, 95% certainty of a rate cut, that's really high. If we start to see that unwind, it's going to add more uncertainty to the market. This is pretty certain. And so it gives the market something to stand on because it has that certainty. If they start to lose that certainty, then things are going to change. So it's worth keeping your eye on this one through the day today. What you would be looking for is this other number to rise, right? Because we're at 475 now. If this starts to go down, we want to see this start to go up. We don't want to see another candle in here something like a 425 way down here. We don't want to see that. And we don't have one now, so we don't want to see one start to form. If they start unwinding this cut, I think we go down. Put it that way. Cause and effect, right? All right, everybody. Watch the clock. Be careful. Be safe. I'll see y'all next week.